let's start out with the Trump presidency, because I think that's really what a lot of the rotation in the market is centered around. So, for a while, I should say I've been not so keen on the U.S. economy, and that's mainly because of the policies that have been implemented under the current administration, and then the potential likelihood of carryover if that was basically the third term with Hillary. Debt stagnation and basically more of the same, dependence upon central banks, regulations, taxes, things that are not growth friendly. There's been some debate. I want to address this back and forth, and I don't really want to get too political, but I want to stick on policy. You've had very punitive policies in place, and the market has been rising not necessarily because of such a heavy growth in earnings or the prospects or business, but on PE multiple expansion, as well as share buybacks and dividends and so on and so forth, because the market has been the only game in town because interest rates have been zero interest rate policies, and in Europe they play around with NERP, which is negative interest rate policy. A Trump presidency, to me, represents a break of that cycle, that sort of race to the bottom. He's going to be focusing more on jobs, lowering taxes right out of the gate, repatriation of foreign money, repealing and replacing Obamacare, which has been a huge tax and has been very largely responsible for some of the part-timing. I often talk about the employment situation and how much part-timing there is, and offshoring and so on and so forth. And then infrastructure, that's going to be a really big build. That's going to be a stimulative effect. Anyhow, that's some of the things that the market is responding to, as well as decreases in regulation. Excuse me. Anyhow, so how does that impact the market? First and foremost is it's raised the prospects of a rate hike, because now you're not only going to have you're going to now have growth and some fiscal stimulus. That's what the Fed has been begging for. You keep hearing them at every one of their meetings, and they talk about, and they're trying to be politically correct. They keep saying they don't know why businesses don't have outlooks, why they're not investing in property, plant, and equipment. And the answer is, frankly, because of the regulations and because they won't invest unless they feel that they can make returns on those dollars. Now, rightly or wrongly, and I think it's rightly, businesses feel that they are going to be able to expand. Anyhow, what has this done to the market? The market has been very narrow the last few years. There have been a handful of stocks that have been carrying the market higher. What the hell just happened there? Sorry. And those are the FANG stocks. So FANG has been getting decimated based on two criteria. One is that they're no longer the only game in town. Yes, they are high growth stocks and they should still benefit. It's not like, Google is not Google anymore, or Amazon is not Amazon anymore. But all of these companies have run a lot. They've been very crowded trades, and they've been the only game in town. Now, if the U.S. economy is going to return to a growth expectation, and there's going to be other businesses that can benefit. So I think that very crowded trade is now getting kind of diversified, if you will. The other sectors are able to make money, like the banks. Everyone has been talking about the banks being in trouble. If Trump takes away Dodd-Frank, you not only have interest rate increases, which is great for their profitability, but now you're talking about maybe having prop trading again and things that are highly profitable businesses for banks. I've said that they've been regulated into basically becoming utilities, and now they could be profit centers again. Let's not get ahead of ourselves just yet. Interest rates. As interest rates go up, the PE multiple premium that is placed on stocks, particularly high multiple stocks or high growth stocks, contracts. That's why you're seeing these smackdowns day after day in the FANG type of names, the Facebook, Amazon, Netflix, and Google, and so on and so forth. And some of the news, I always say, falls along the line of least resistance, and that's been smacking a couple of those, Facebook and Google in particular, with the fake ad thing that's been coming up, and the potential for not reaching as many users as possible. I'm going to cover that in a minute. But like if you look at some of the bounces, excluding Apple, I don't really lump them. I guess I lump them in a little with FANG, but not really. Take a look at some of the bounces, even just the last couple of days. They've been kind of meek. I mean, Facebook was down again today. Google, up $4 or $5 after being down ginormous. Amazon, getting a bit of a bounce, but still down over $100 from where it peaked. And Netflix was sort of the lone ranger in the sense that they've been able to kind of hold on to their gains. They were like one of the first to report, and they had good earnings. It had already been down a lot as well. So let's so where do we go now? So you've seen where the money is flowing. I think you've gotten a bit of a glimpse of Christmas yet to come. It's flowed into the banks, it's flowed into the materials, it's flowed into the industrials, and it's flowed into the small caps. Because IWM and so on and so forth, these all are highly levered to U.S. growth, not international growth. As the dollar rises, companies that do business overseas, like, remember it's already a while ago already, but over a year ago or so when Facebook would report, and if they ever had issues on their quarter, it was always currency related. That isn't going to get any better. That's actually a bit of a problem. And I'll tell you, the headwinds that I see going forward, and I'm sure the Fed is going to be mindful of this, although at this point I think it's basically a done deal as far as the rate hike in December. I've been saying that all year. I had said in the last couple of minutes it was not yet a fully done deal. Remember, I had said that they moved off of dovish, not yet to neutral, but kind of in between. The last minute sort of pushed them a little bit further to that side. So I'm saying that they're probably closer to neutral now than they might have been in the past. And I think that that's really evidenced by what's happened in TLT. So keep in mind, we're going to go through all of these now. Let me just get myself on a bit of a larger time frame. So there are a couple of things that are happening. One is that the dollar has absolutely exploded. The low in the dollar was 92.83, and that is now trading at over 160. The recent peak was actually about 160, so we have a bit of a double top here. So I had done a projected move in the last couple of videos, and I had said we would probably be getting closer to this 160, but 99, 79-ish. We're now puncturing that upper part of the channel. So remember what I say, coming up from the bottom. We have come up from the bottom to this level, so it is possible we do punch through a bit, but I am actually expecting the dollar to maybe back off a bit. There's some good and bad news here. The bad news is that the dollar is up a lot, but could go higher. If you do a Fibonacci retracement from the peak in like 2000 and, I don't know, what was this, 2001, when it was 120.29, and you bring it down to the low, it's 71.05. Why aren't you? There we go. 102.098 is the 61.8. So there could be a little bit more room to the upside before we get a bit of a pullback. I've also noted in the past some levels of like 105s, 106s, which is a lot. I mean, these are huge moves. If that does happen, that's going to be a big deal. So like I said, I think the dollar has moved a lot, and I think it probably is due for either a little back and fill or some consolidation. So that might put a little bit of relief. Yeah, someone asked about me to post the chart. Watch the Sunday video. I'm going to go through this like nobody's business. This thing is going to be serious stuff. With regard to the bonds, they have also come down quite a bit. I've said for a while I thought that the bond market was a bigger bubble than the stock market because 2009, like let's talk TLT terms, 123.15 was the high. That was sort of the end of the world trade, and we got up to now like 143.62. That's a lot. Jeez. Anyway, we're pulling back. So far, the TLT has held the 50-week MA to the it undercut it slightly. There has been a couple of other tests there, and they've held. This is a big decision point for the for bonds here. We're roughly at some fib levels. It is at that 50-week moving average. So it's sort of F or walk here. It really needs to hold this like 120, 121 level. If it were to snap and we were to traverse all the way to the channel low, I'm thinking that there was a reference low, the channel low, which is also trend, comes in around 114.88. You have a 100-week MA a little bit below there, which is 112.36, but I'm guessing that that will ease on up into that area. So I'd be interested for a right or right out trade, either if you want to do it here versus that 120.73 low, I'm fine with that. Or if you're going to wait with your kind of your catcher's mitt to put it in your glove around 114.88, like 114, 115. I think that area will be big reference support. So that's what I'm thinking with regard to bonds. But remember what I've talked about. I've proposed a lot of complex. I tried. Some of this stuff is mind-numbing, but I've been trying to put this together in ways that are easily understandable, and I often like to reference movies and music and things like that. Yes, I play to the 1% of you who know what I'm actually talking about with that. But anyway, I entertain myself, so it's all worth it in the end. I've talked about the upside down, where I talked about how companies have been issuing debt to lower their weighted average cost of capital, which just is the discount factor when you're factoring in DCF analysis, which is discounted cash flow analysis. I have been wanting to do a video on that, but I've been reluctant because I don't know how beneficial it's going to be for everybody. But I've put in a video or put in a link. If you look in the description of this on the YouTube page, it's a weighted average cost of capital spreadsheet at my alma mater at Stern. And if you screw around with the interest rates there, you can see the difference in the end product. I highly encourage people to do that. And if you're really curious, even more curious about this, look up convexity with regard to bonds, and you'll see the the moves along the interest rate are huge in terms of the price. So I don't want to get into too much. I'll tell you, I've done so much work in almost a former life on bonds that I probably could. You know how they always have the military guys? They assemble the guns with the sleep mask on in the Marines. I could probably do that with bonds. But anyway, that's what I'm thinking. We need to either hold right here in TLT, or we're going to see the 114s. And I actually like, if you want to play for that short move, I wouldn't even mind a put ratio or a put spread. I would wait maybe for a bit of a bounce in it. We're getting it now. See how that fares. So that's my story with bonds. But you've had this sort of financial engineering world, and the stocks that have kind of done that or the ones that have benefited from this, or the ones that have kind of been bond equivalents because the yield has been so small. This is always I'll tell you from experience, when we've had major financial crises, it always starts with a reach for yield. People are willing to take credit risk because things are, it's millet time, and they buy things that are risky just for a little bit more yield. And you're seeing people who piled into high, dividend stocks. These have also been slaughtered, kind of like even worse than what's happened in FANG. Like if you pull up XLU, I mean, this thing has been getting the wackarooski. If you pull up HYG, that's been getting a little bit of a pullback lately. We played that to the short side and covered actually near the dead lows with that. This is a stock I really like. This it's a real estate kind of play, realty income. That's been getting hit pretty badly. But I mean, if you look at the scale of the move in these things, this has all been the chase for yield. And the issue with all of this is that they've been piled into for so long, and people haven't really thought about it, that these trades are really crowded and that they can really pull back quite a bit. I've been hinting at being a little bit more bearish with regard to stock. Yeah, like J&J. I mean, let's take J&J for example. This is like, a big blue chip stock. Everyone, uses Band-Aids or what have you. Stuck on Band-Aids because Band-Aids are stuck on me. This thing is like up huge. It's a very low growth name. I mean, I don't have their stats in front of me, but they're probably a single digit grower. If I'm wrong, someone let me know. Maybe they're, a multi-digit grower, but I think that they're a small one. And they're trading 20 times earnings. Conversely, Google is only trading 28 times earnings. So which one of those two do you think is growing quicker? So like Google isn't very expensive, but I think the fear with Google is that their ad revenues might slow if the economy slows. So, yeah. These things are really, really expensive, all to chase how much is this thing yielding? Why is it? Oh, no, it's Google. Now it's to chase a 2.75 yield. So as bonds come up, as they become, as people are risk averse and they've been forced into stocks because they look like bonds, now that bonds are back to being bonds, right? When men were men, when bonds were bonds. Now that bonds are back to being bonds, people are selling these other stocks and buying the real thing. There ain't nothing like the real thing, baby. So they're buying the bonds. That's interesting because as the yields come up, oddly, people want to buy more bonds. That's sort of how it works. So let's take another one. Coca-Cola, for example, knockout, right? KO. This thing is also trading at like all-time highs. It's come off a bunch lately, but for sugar water, people are paying 25 times earnings. Yeah, someone just said J&J is growing at 4%. They're trading at 20 times earnings. That's insane. That thing could be, clobbered and clobbered and clobbered at this point. Coca-Cola is also likely a single-digit grower. They make sugar water, right? For 25 times earnings. Someone just said Coke is minus 2% here. I mean, they're actually contracting, and the stock is trading super duper expensive, all to chase a 3% yield. We know the Fed has said that they're going to normalize at 3.5%. I think the fear is that this is going to come up too far too fast, and that it's going to force the Fed's hand to do more rate hikes quicker. I'm expecting things to kind of cool down a little bit. This might be sort of a reverse sell the news kind of thing. Like maybe they sell the bonds off ahead of the Fed, and then it's kind of a buy on the actual rate hike. So we'll have to see how that trade sets up. If they keep selling the bonds off, I think it could actually be a long for the rate hike, as crazy as that sounds. If they rally it ahead of then maybe there's the move lower. So it might be another one of these Costanzas, do the opposite. High yield. This is something that I have had my eye on for a little while, and I've been a little bit, I was bullish back a while ago. Now I'm a little bit more bearish. We got a retracement at the peak here of 61.8 Fibonacci retracement from the complete from the move from the highs, the 106.46 highs to the 61.50 lows, and now we have pulled back a lot. We're starting to pull back. If you were to get a full 61.8, like we rallied 61.8, but if we get now a 61.8 retracement of the entire move, that takes you down to 79.85. I've been noticing, and what got me into the short with this thing was I was noticing the puts being bought in size. And I was also starting to notice oil going lower, and I put on that put spread. I think I had the, what was it, the 86.80, I don't even remember what it was. Maybe 84.80 or 80, I think that was something along those lines. But I talked about covering as we got into the gap fill area. I actually covered slightly ahead of it. It was not the dead low of the day, but it was pretty close. And we now got a pretty significant bounce. My view with this high yield is we need to keep an eye on it, because if this thing starts really plummeting and getting out of control, we've got problemos. This thing rallied back up to where the breakdown point really was. It actually got a little bit above there. we had the main breakdown below 85.27. Yeah, 84.81 was one of the breakdown areas, but the real big one was 85.27, and we kind of had a bit of a look above and fail, and today we were a harami inside there with a close below the 10-day. So what now with that? I think you could use today's range as a gauge. Above the high, I think you could play for long for maybe more of a bounce. Maybe it comes back up to like 85.91. If we continue down, that would, by the way, be a 61.8 of the recent leg. If you lose the low, this 84.73, I think we could fill that gap to 84. We basically had a double bottom here the last couple days, and we're kind of within that bars range. So if you want to be aggressive, this is how I would play it. I'd play either long over today's high tomorrow, short below today's low tomorrow, and then I'd step on the gas over the 11.15 bar. Like I would add to the long over the high, or I'd add to the short below the low. So keep it super simple, stupid. That's how I'm a man of simple thinking when it comes to the markets. I don't like to I often like to overanalyze things, but I like to keep it real simple when it comes to stuff like this. So that's my trade idea with HYG. The initial entry over or below today's range, and then step on the gas over over Tuesday's, either over Tuesday's high or below the low if we wind up going with the short. So that's HYG. Oil. So here's the scoop with oil. You had one of my favorite types of patterns, either the look above and fail or the look below and fail, and we had a massive look below and fail on Monday. You had come down a lot. You had that big hammer on 11.9. The 2 days later, you were at that low, and then Monday you had that big move below, and then with yesterday's candle, you now have basically a secure low setup, basically right around the 200-day moving average. It doesn't get any prettier than that for this type of a setup. So you came back up today, you had a little failure, a look above and fail on the 100 MA on some bearish inventory, but I like that we kind of held the high of the range from the prior day. So I'll keep it real simple with this. As long as oil can hold over the 10-day MA here, which had been a little bit of support and now is it was a little bit of resistance, it should now be support again. It looks to me like it's 44.61. So as long as that kind of can hold, I'm all right with oil. If we start getting below there, the pullback to me would be a little bit too much and it would be a little bit more suspect. So we'll keep that simple with regard to oil. China has been coming down a lot, as has the BABA. The FXI broke down the other day, and it's below the 10-day, it's below the 100 MA, and you have now 50 MA, which seems to look like resistance. It's kind of bending over. The 100 is still upsloping, the 200 is still upsloping, that's okay. Although the 50, the 20, and the 10 now are all downward sloping, and you're getting some crossovers, which is not good. I'm a little suspect with FXI. I think that they're going to have some issues with Trump with the trade negotiations. He's talking about labeling them as a currency manipulator. I think that there's going to be some beef with China. So I'm a little suspect with regard to with China, the ETF. I will say this, the 200 MA was very difficult to get over and above. If we could get to the 200 MA, which is 34.69, I would try a right or right out play there, but I'd really be more interested in targeting like 33.62, which is a 50% fib, or the 61.8, which is around 32.31. So you have now 4 days of consolidation below the channel low, and if you were to break that low, which is 35.48, I like it as short to the 200 MA, cover part of the position, and then see if it holds or not. If it doesn't hold, then look for the 33.62. If you can get now back up above the, let's say, 10-day or 100-day MA, then I would say that this whole thing was a big head fake to the downside. This BABA has been acting like an oinker. I can't say that I didn't tell you so, because I really did. I had said I thought this thing would get max to like 110. It got 109.87. I talked about getting out of it up there. The momentum filled my call spread. It was actually like almost at the dead high, which was really nice. I had still maintained some short puts, but wound up taking those off, and the stock now came down. So there's some good news and some bad news with regard to the BABA. The BABA basically filled the gap. I'm just going to basically call this a gap fill. It held trend and channel. The next 2 days, yesterday had a look above and fail, and then today was stronger than I thought based on yesterday's close. So you have now 2 days worth of consolidation after the bounce. I'm going to keep this super duper simple here. Let's use the 2-day low and the 2-day high. The low was 90.75. Anything below there to me, it's not behaving well, and it's probably going to come back down and maybe get 84s. I could even scare the pants into you guys and say 78s, but for now, let's say 84s, 85s, that's right where the 200 MA is. Above, we're running into some technical issues. You have a 10-day and a 100-day MA roughly around 95. So you could play for a quick pop, like a trigger over the 2-day highs for a move to 95, and then kind of be a cool customer and see what happens. If that doesn't hold it, it should see 98s pretty fast. At that point, we'll have to reassess. So that's what I'm thinking with regard to BABA. If you don't mind, you could probably sell some very near-dated out-of-the-money puts. What else do I want to cover? So you've had a interesting move in Apple. This is something I actually I have a small long on in this. This got the gap fill and then some to 104.08, which was, did it get to the tick? Yeah, to the tick, like a boss, to the 50% fib, and bounced. So I like when things like that happen. It's now back up over the 100 MA and over the 10-day. So I'm thinking that this is going to get a 50 MA test at 112.81. That seems to me like it's in the cards. Where did we close today? Closed all right, almost 110. So yeah, that's sort of what I'm thinking here. There's a gap to fill in Apple all the way up to 118.25. I don't know if we're going to get there, but I do think 115s aren't so unreasonable. So I'm looking for something like that. I'm playing that long with a call spread. What do I have on? 110, 120. So yeah, I have that on, and then I think I have another one on in another account. Let me see. In another account, I have another. This is a bit more of a. That's just I usually don't like to do things like this, but I did it because the IV is so low in this that the risk versus reward could be huge on a volatility expansion. Given where the VIX is low end of the range, and given where Apple is in the range, I also have a 115, 120 on. But all of these are really small plays. These aren't anything ginormous, but that's what I've got on. So I'm looking for a bit higher in Apple. Yeah. If we were to get now back below 108s, which is 108.02, which is the 100 MA, I would not be... That's also the body of the 11-10 day. If we were to get below that body close, which is 107.79, yeah, I will not be in that anymore. All of that will be brought off. I would not be comfortable with a sustained move under there, particularly a close. I'd actually probably be back short looking for a move to 100. That would be the 61.8. Apple really loves technicals, but this has moved down a lot, so I'm thinking maybe a little bit higher. That's one of these that I like. Amazon did almost completed. I wish it actually would have gotten a little bit lower because it would have hit my trigger point. It hasn't yet. Now I would not be a buyer. I was talking about being a buyer at 696.44, basically on the 200 MA, but we've now come down, almost got there, bounced a little. It's not much lower than the last bounce point. So I would be not so thrilled if it came to buy it there. And this is still by no means out of the water. It's below the 50, the 10, the 100. I mean, this thing is just, it's like still on the 200 MA. Where I would be starting to get more interested is now at a fib. I would probably be starting to think and listen, this could still have a pretty solid bounce. And remember when the last time it had that 200-point decline, it first had a 100-point rally off of a intermediate low. The move had been, it was like 148-point decline with a 90-point bounce, then to follow down to complete the 222-point decline. So it looks like it's doing a lot of that. We might be getting that bounce here to come up, only to come down lower into the channel low. The channel low, by the way, would coincide roughly near the gap fill around the 602 to 616 area. I don't know that we're going to get that full articulation lower, but I wouldn't be surprised to see the 660. What I'll start doing if we rally and then come back down, is realize the measured move and start selling, either start doing put ratios, meaning buy one, sell two, outright put spreads, or waiting till it comes down there and sell some out of the money puts. I think it's going to depend on just on how high the bounce goes. I may be into selling some out of the money calls on the bounce. A couple of things happened on the way to Amazon for me to think this. First and foremost is it got my target. It got that 833, which is the 1.618 fib extension. It even went a little bit beyond there. Sometimes they sell too soon. This was a case of a little bit too soon, but if you were out at 833, I'm sure you're a happy camper now. You might not have been at 847, but 100 points lower here, you know, I'm a villain, right? So that's the story. Facebook is one that I'm starting to get really, really concerned about. Keep in mind, I don't want to, say I'm the axe in Facebook, although I kind of am. I hated the stock at the IPO. I got bullish around 20. It got to 19, and then it ripped and never looked back. So, and I had been saying it would get to 100 and beyond. I talked about this thing getting to the 128s, went to the 130.43, which is the 1.618 fib extension. It got a little further than that, and now it's been down a lot. So there's some technical problems, believe it or not, with Facebook that I'm watching here. And I don't want to make any extreme calls like that it could get back to 72, but it could. I'll tell you the story here with Facebook and some of the things that I'm a little bit worried about. The stock got my extension. It hit every one of my price targets, and it did it with style. We're below the 50 MA, we're below the 100 MA, and we're below the 200 MA, and below trend. We're futzing around here below the 200 MA. A couple of things I've noticed before with Facebook is that it had a lot of technical support at the 200 MA in the past, as well as the 50-week MA. We basically tagged the 50-week MA last week, bounced, and then this week broke it and now hovering just above it. That's 116.34. If we lose that, and that to me would be a reordering in thinking with regard to Facebook. The last time Facebook closed below a 50-week MA, I'm in a 3-year time horizon, and I have to keep going. It hasn't ever, since the run, closed below the 50-week MA. Since this thing got going, with the big candle up in 12 or 13, whenever this was. So this is a big frickin' level for me, and if it loses it, I think we're going to 101.56, which is the 100-week MA. Yeah, so this is a big deal here. This could be a very, very big call for me as well. My rationale behind being a little cautious here, and listen, we could get back up over the 200, and then this could kind of start righting the ship again and fill the gap, and maybe make a lower high. But I'll say this. A lot of people I know are very, very long in this stock. They were long ahead of the quarter. They've been long for a while. There's a lot of people who have bought in and chased. And I know a lot of funds have this as their big holding. A couple of pieces of information have recently come out that have me a little concerned. I wouldn't say crazy bearish, but their metrics are looking a little odd. There's these fake ads that are coming up. They could have as much as 55% less views on some of the advertising. The good news for Facebook is there's really nowhere else to go. It's just either Google, which is web, or Facebook, which is social. So they're protected in that sense. But I could see them maybe having to take a big charge or make good on, that's what it's called in advertising, make good on some of this and give discounts, and that would hit the bottom line like a ton of bricks, and you could see a pretty nasty move in Facebook. Longer term, I'm probably still a little bit more bullish, but I think the stock could really could come back maybe to 108s or 101. Keep these levels in mind. We have now 3 days closing below the 200 MA. I would start leveling into this thing short if we get a weekly close below the 50-week MA. I'd love to see a bounce first, though. What to me was really telling was you had the gap down below trend, a rally back up, a fail at the 100-day moving average, which was a look back into trend, and then a complete failure below it. And now we're kind of within that big bars day. So the low of that day was 115.27. Anything below there with closes below there to me now is suspect. If we can get back up above, you really need to get back up above 124.18, believe it or not. That was the kind of the big emotional day to really start righting the ship here, and that's a lot of points away from here. So I'll keep it even more simple here. Below the 200 MA, I don't really want to be long. Back up above it, I'm kind of like, all right, trying. So, and a close below the 50-week MA, short. Simple, stupid. Netflix is just kind of hanging out, drinking stout. I would be interested in this for a right or right out trade around 106.90. That's a 50% fib. It's also roughly kind of the big breakout where there was last price. What I would do there is probably sell out of the money puts, something that would be close to the gap fill. The full gap fill would be 99.80, so you have a 61.8 around 101, so sell the 100 puts when it's maybe at the 106, 107 level. 109.24 is the 50 MA. That was a lot of support. So somewhere in there, I'd be looking to sell some out of the money puts. You also, if you were to come down to trend tomorrow, would be 101, which is the 61.8 and the trend and the channel. So yeah, that's the area. I'd be looking to sell some near dated out of the money puts. The Goog. So this thing really was a bit of a head fake. I had actually been playing long and got stopped out of this, and JP doesn't really love getting stopped out, but it happened. You had this kind of look above and fail on the day that they announced, I think it was the Hillary day, and the stock really came down a lot. It had a bit of a look below and fail with regard to the 200 MA. I was really looking for it to tag the 736.01, which it didn't, which is the 61.8 of the range. It got close, and now we're kind of futzing up back into some levels. You're still below the megaphone. You're still below the 100 MA. So I'm a little cautious with the Goog here. It to me should probably be stronger than it is. It's a relatively cheap stock based on a PE multiple, assuming you believe the earnings are okay, which I think they are, given the fact that they reported an all right quarter. But you're still below trend, and until you start to see this thing make higher lows with higher highs, which we have not been achieving, I'm cautious. So that's the story with Goog. If it continues lower, By the channel low, I'd be more interested, and that's kind of far. I mean, you're talking about like closer to 700 in the high sixes at the moment. By the time it got there, it'd probably be closer to the sevens. So it's really do or die here. 100 MA to me is really key. Below it is iffy. Above it starts to correct. Some of the bank stocks have, let's cover NVIDIA quickly. So I've been looking at this NVIDIA. This thing is just unbelievable. I think that people have been asking me how to play AI and artificial intelligence, and these guys make all the chips for that stuff. So they've been rocking it hard. A couple of funny things, though, happened, and I'm going to cover this. I think if you're really interested in this, watch my weekend review video on Sunday. It's going to have a lot on NVIDIA. Today, the last couple of days, God, this thing is just up so far, so fast. It had been basically, for the most part, riding in a channel on either side of kind of the 10-day moving average and holding the 50-day. It is in launch mode here now. They reported that great quarter. The stock is up. It had a couple of days of consolidation, and then today broke out. I'll keep it real simple. If it can hold above 88.77, the thing is still going higher. It kind of has like those $100 eyes. It looks like it wants to get 100. It might even get higher. But I would be more of an interested buyer if you haven't bought it before and you're thinking about like where can this thing pull back to. The 50 MA has been fairly rock solid support. The 100 MA will probably coincide with some important levels soon. So if you were to get some kind of a violent pullback, I'd be into the 50 MA. That said, anything above this 88.77, someone asked me, do I think it's extended? Yeah, the stock is very, very extended. This thing to me looks like Netflix when it was on its epic run. But here's the question. It's extended at 92, but it could be even more extended at 150. These things can happen. When stocks get into that blow-off phase, it starts moving in big chunks. So, I mean, this thing could be up for like 10 points a day for like the next couple of days. I'm not looking to step in front of this thing. I like to play along the line of least resistance, and this stock is making higher lows and higher highs. That means it's a buy-the-dip stock, as crazy as it sounds up here. I'm personally not chasing this up here. I will be looking for an opportunity to buy it on a bit of a pullback and probably play some games with volatility in this. I'll discuss some setups in the weekend review because then I can show you on the charts my points of entry and exit. So let's sidestep that for a moment, or put it on hold for a moment. The banks, these things are just on fire. By the way, I just want to address dry ships quickly. Dry ships is up on a short squeeze. There's very little float. There's no borrow to short the stock, and someone clearly was in this thing short. And they are paying. This is the kind of move that puts people out of business in the dry ships. So this move won't last. It will probably come back down to earth at some point. I can't tell you when. No one knows. Whenever the whoever is being the squozen will, when they're done with whatever pain that they're in and they're out of business, that's when this thing will likely come crashing back down to earth. The Baltic Dry Index is doing better. I think that someone was playing this thing for a zero. I've never understood why you're short single-digit stocks like this. Anytime I've ever seen something even remotely like this, and there have been a couple, it's always something like this, that someone was caught in size short in a stock with ill liquidity, and you get this kind of a move when you take tail risk off the table, meaning that they're not going to go out of business. The banks are up ginormous, and I have hated the banks for years. I have been softening on that recently, though. Why? There is the prospect under a Trump presidency of repealing Dodd-Frank. That takes these companies from being utilities that pay dividends to growth names again. That's been my big beef with these companies, and I've said that this thing was looking like an inverse Head and Shoulders. It's now broken out. You have a 1.618 Fibonacci extension at 2385 in the XLF if you go from the peak, not to the flash crash low, but to the pullback low. So I used 2080 to the 1586 low. So there could be some more room up in this, but I don't know how much more. The kind of the easier money I think has been made. If there was some type of a pullback, and this thing is way ahead of all the moving averages, if there was like a pullback maybe to like the neckline here, somewhere like closer to 2028 to 2080 maybe, a couple of point pullback in there, I'd be interested in maybe either selling puts or just buying shares. I think that this will go higher. If they have the Fed raising rates, and you have regulations being stripped away, like putting prop desks back into these bad boys, they can make money again. I've, before that, been more of a fan of the insurers, and I still like them. But if banks are kind of back to being banks, they can move further and farther. However, I still like the insurance companies, the MetLifes, the Travelers, although it's funny, Travelers had a better chart, now Met has a better chart, so maybe go with the MetLife. Travelers is, yeah, wow, they're right back to the 50 MA. The chart in that one looks a little bit better to me. Any concern given few large banks? I don't know what that means. By the way, JP Morgan, there's rumors Jamie Dimon may be the new Treasury Secretary. I don't know how credible or not that is, but we'll see how that plays out. JP Morgan is up a lot, and it came up really from the bottom. It's getting a little parabolic here. I think that this would probably be a buy somewhere back in the high 60s. That 67 was an important level, as well as 68. I don't know if you're going to get that big of a pullback. Maybe there's some. You would really need a larger market correction, but I think that there will be some pullback in the move. Let's see if we were to draw in a fib. I'm just looking around this from the Jamie Dimon low. I'm going to use that, not the flash crash low. And let's just assume this recent high was a peak, and I don't know that it is. Where's the Jamie Dimon low? That was 52.50. Let me adjust this fib. It didn't snap properly. I'm going to take out the 38.2 because I don't really like those. Yeah, 50% fib is 66.47. So assume it goes a little higher, somewhere in that area. The failure pattern of the remember I said the Head and Shoulder, all these stocks had failed Head and Shoulders. That was 66.20. So somewhere down there, if God somehow there's some type of a pullback that big, I just don't know that that's going to happen. But if we could get somewhere down there, I would be real interested in loading up the boat on these things. Maybe if the Fed doesn't, maybe after the Fed there's a sell the news or something, or there's a larger market correction. This thing is now basically trading at or above the channel. So I'm thinking that this could have a bit of a pullback. For a day trade, I like it on the 10-day moving average, which is 73.89 and rising. So that could be an interesting day trade. All right, so I think that covers a lot of what I wanted to talk about. Someone had mentioned astutely that Cisco is down 5% after hours. I was actually looking at their quarter. I think there was some slowdown in the data centers. That's not good for them. This was basically poor highs. It had came down, rallied back up, and now back down. Where are we trading after hours in Cisco? Where is it? That's weird. It's not on my watch list. On this watch list. Let's do it here. Intraday. 2 day, 5 minute. Yeah, we're down to 30.31 was an important level. It seems to be resisting there. The big number that I'm watching here is the 200 MA, which is 2909. So that's also the edge of a big volume distribution. Are there any fib numbers in there? We're going to end on this sucker too, by the way, so let's go out here. Yeah, I think this was again, came up from the bottom. This is a really big move. Fib level, I don't know if we're going to get it for the full extension there. From 2246 to 3190, 93, 95. That would get you, and I'm going to take out the 38.2. I don't buy 38.2s. Yeah, that's a pretty big pullback. The 61.8 is 26. I don't know if we're going to get that low. I like this. If we were to open up like dead on the 200 MA, I like a 200 MA right or right out play. So that's sort of what I'm thinking. If we could get lower, like the 50% fib, which is like 27s, I'd probably sell 26s. So we'll have to see how that plays after hours. But I do think that the 200 MA is going to be the key here. Anyhow, that's my story. I'm sticking to it. If you came into this late or want to catch it again, I'm going to post it on my YouTube channel, which is Justin Pulitzer Trades. If you're not following me on Twitter, it's @JustinPulitzer. Wow, we went over 53 minutes. I was hoping to be a half-hour video, but we went for a while. Anyhow, I'll do my Sunday video. I may do it on Saturday. We'll see. Depends on my schedule. Hope you enjoyed the video. Have a great weekend, and cheers.